In a report that was released out today, what we're seeing from Renaissance Capital is that US data points to quantitative easing not actually having an effect on stimulating growth and stability in America. The Federal Reserve would have liked to have reduced some of the structural problems we're seeing in America. There's also the issue of a heavily indebted European Union and what this is presenting as a challenge for the Eurozone. The impact for Sub-Saharan Africa, Rencap has come up with some modest assumptions as to where Africa will stand, apparently not quite buffered in this time around as we saw in the recession of 2008. Yvonne Mhango is an economist for Sub-Saharan Africa at Rencap. She joins us now. Yvonne, thanks so much for your time. Okay, poor sentiment in Europe, sluggish growth in the United States, all of these have a bearing on the global economic recovery process. Are we headed for a double-dip recession?
Well, we're of the view that yes, we're going to see a mild recession, at least in the West, that's the economies of the US, and as well as the EU. So that, of course, will have implications for our growth outlook and hence our review of the growth projections for the Sub-Saharan African countries.
Okay, so a milder recession possibly going forward. How badly affected will Africa be this time around? Because in 2008, we were told we were insulated.
Yes, this time around our buffers are significantly weaker. If you recall, in 2008, we'd come from about 5 to 8 years of improving macroeconomic stability. This time around, we've got worse fiscal balance positions. If you look at the case of Nigeria, they went into the first crisis with the surplus position there. Now they have a fiscal deficit, which they're trying to rein in. The current account balances also aren't as attractive as they were in 2008. Nigeria is another example where the current account surplus dropped significantly from the double digits as a share of GDP to close to 4% of GDP. In addition, the forex reserves positions have dropped not just in Nigeria, but also in the case of Kenya.
Okay, so what does that mean for overall growth if the leading economies regionally are under a bit of pressure?
All right, we've moderated our growth forecast, for instance, for Nigeria down from 7.6% initially for this year to 7.2% and 7% going into 2012. One of the big reasons for that in the case of Nigeria anyway, was the contraction of the oil and gas sector in the first quarter. So that's not related to the global economic downturn, but that already dampened the economic performance of the first quarter of the year to around first half of the year to 7%. And given that oil prices are moderating, we expect that to have a moderating effect on economic activity, at least in the oil and gas sector, going forward. So it's a moderation of the growth projection, but not significant. In the case of Kenya, we've brought down our growth forecast for 2012 from 5.1% to 4.5%. Aside from the impact of the global economic downturn on demand for tourism, for instance, tourism is a major source of export earnings, as well as horticulture. We're concerned about the impact of this significant tightening we've seen, of course, in the past week on monetary policy, what that implies for credit growth going forward. So we expect that also to impact growth for Kenya.
Okay, you've talked about softening of commodity prices. You've mentioned oil. Is that across the spectrum for commodities? And what does it mean for growth? Because to a large extent, the buoyant GDP figures we've seen have been commodity-derived figures in commodity-rich economies in Africa.
True. What we found during our analysis is that when commodity prices spike, as you rightly said, the resource-rich or resource-intensive economies tend to grow rather strongly, and you find that the gap between their growth and that of the resource-light countries tends to widen. But as a whole, the region grows strongly, as we've seen during the previous commodity boom around 2007. However, when commodity prices soften, as we expect this time, not as severely as we saw in 2008-09, what you find is more balanced growth within the region, because I'll pick Kenya, for instance. The high oil price significantly impacted the cost of production in that particular economy. We saw that what it did to inflation. So as a result, the imports or the oil importers are expected to find some sort of relief from a lower oil price.
What does this mean for investment flows into Africa? I mean, we've been watching capital inflows into the continent. They seem to have slowed. We're seeing a bit of a sell-off in bonds. But does slowed inflows necessarily mean higher outflows?
During the periods of volatility, of uncertainty, yes, you have seen significant outflows, as we did see in August when global financial markets first started to show the concerns about the economic outlook. Yes, indeed. During such times of risk aversion, you will see a slowdown of capital inflows. However, I think the composition or the destination of those inflows is something we should look at. So right now, for instance, you've seen a significant increase in interest rates in the case of Kenya, not just Kenya, the broader East African region, as well as in Nigeria. As a result, the local currency debt markets have become significantly more attractive, not just for the local markets, and that includes both commercial banks and local funds, but also foreign investors seeking to get higher yields in this time will opt for the local currency debt markets as opposed to the equity markets. So the outlook is that we expect to see a greater slowdown in inflows into equity markets in the African stock exchanges.